Global inflation has been a significant concern. After reaching a peak in 2022, inflationary pressures have begun to ease. This is a positive sign. However, inflation remains above the comfort levels of most central banks. The causes of this global inflation are complex. Supply chain disruptions, geopolitical tensions, and the after effects of the pandemic all played a role. These factors combined to create a perfect storm. Fortunately, there are signs that inflation is starting to moderate. In many parts of the world, we see a decline in the rate of price increases. This suggests that the aggressive measures taken by central banks are beginning to have an effect. This is encouraging news for the global economy. Central banks around the world have played a critical role in combating inflation. They have implemented a series of interest rate hikes. These hikes make borrowing more expensive. This helps to cool down economic activity and reduce demand-driven inflation. The effects of these policies are starting to be felt. The U.S. Federal Reserve, for instance, has raised interest rates significantly. Other major central banks have followed suit. The pace of tightening is expected to slow as inflation moderates. Some experts even predict rate cuts in the near future. This would provide some relief to borrowers. However, central banks face a delicate balancing act. They must control inflation without triggering a recession. This is a difficult task, and there is no guarantee of success. The coming months will be crucial in determining the effectiveness of monetary policy. Global economic growth is projected to be modest in 2025. Developed economies are facing slower growth compared to emerging markets. This is partly due to the effects of inflation and tighter monetary policies in these countries. The United States, despite facing inflationary challenges, demonstrated resilience. Its economy outperformed many other developed nations. In contrast, Europe faces sluggish growth prospects. The energy crisis triggered by the conflict in Ukraine continues to weigh on the continent. Emerging markets in Asia, led by India and China, are expected to drive global growth. These economies have benefited from strong domestic demand and robust manufacturing sectors. However, they also face challenges from global trade tensions and capital outflows. While there are signs of easing inflation, several risks remain. Geopolitical uncertainty, particularly the ongoing war in Ukraine, continues to cast a shadow on the global economy. Additionally, trade tensions, especially between the United States and China, could disrupt global supply chains and fuel inflation. The strength of the US dollar is another concern. A strong dollar makes imports more expensive for countries that rely on dollar-denominated trade, potentially adding to inflationary pressures. This is particularly challenging for emerging markets. Looking ahead, the global economy is at a crossroads. While the easing of inflationary pressures provides some optimism, significant challenges remain. The path to a full economic recovery is likely to be bumpy and uncertain. Policymakers worldwide will need to navigate these complexities carefully to ensure sustainable and inclusive growth.